Well, greetings, millionaires in training. We're now going to do our chapter video preview for chapter 4. We're going to start with retirement plans and go over qualified versus non-qualified retirement plans and look at what these two terms mean. When we see the terms qualified versus non-qualified on our Series 6, they have to do with the tax status of the money that we're putting into the plan. So if a plan is funded with qualified money, that means that the money qualified for a tax deduction in the current year. The contributions go in pre-tax, and there is no cost basis. The cost basis for a security is the total purchase price for the security with after-tax dollars. It is tax deferred. That means we don't pay any tax until we withdraw or take the money out. And the tax implication upon withdrawal is that everything is taxed at ordinary income. So how is a non-tax qualified contribution different? Well, with non-tax qualified, the contribution did not qualify for a deduction in the current year. It is funded with after-tax or post-tax dollars, so we do have a cost basis, our contributions. The earnings still grow tax deferred, so the earnings in the account grow tax deferred, and the investor doesn't have to pay tax on the money until it's taken out at withdrawal if it is subject to taxation per the IRS. So what are some plans that are funded with qualified and non-qualified money? Qualified money plans include traditional 401ks, a 403b. It is for only qualified. It is the only qualified annuity. Most traditional IRAs and KEO plans. Non-qualified money goes into the following type of plans: Roth 401ks, Roth IRAs, non-qualified variable annuities, some traditional IRAs, Coverdell educational savings accounts, and 529 plans, Section 529 plans. The Employee Retirement Income Securities Act, or ERISA, of 1974 is designed to protect employees from their employers in qualified plans. ERISA is what we would call this piece of regulation, and it was designed to protect employees from their employers, and ERISA requires that all plans must be in writing and they cannot be discriminatory against any employee. Private sector. So ERISA is only for the private sector, which includes corporations and sole proprietorships. Who did ERISA leave out? Nonprofit organizations and the government. The plan must have a written vesting schedule, which means ownership. Most plans will have an employer contribution, either a 3-year cliff vesting or a 5-year 20% per year style of investing. So with the 5-year 20% vesting at the end of 5 years, the employee that owns 100% of their employer contributions. A pension plan is our main defined benefit plan. It is non-contributory, which means employees do not put money into the plan. Instead, it's only employer funding. Contributions from the employer may vary, and the benefit out at retirement is always based on a formula. With a pension plan, similar to other defined benefit plans, the employer always assumes the investment risk. A 401k is for corporation, and a 401k is a salary deferral plan, and it's a defined contribution plan. So we know that the money that we're putting in. So this type of plan, part of my salary goes in pre-tax. The employer can also make contributions. Most 401ks will allow the investor to take a loan. The maximum contribution that an investor can make into their 401k in 2025 is $23,500. Although if the investor is age 50 or older, they can contribute an additional $7,500 per year for a total of $31,000 in 2025. I don't assume on the exam that they're going to focus on 50 or older. So when it comes to any retirement plan catch-up contribution, don't assume it unless the question directly asks you about that. And then finally, with a 401k, withdrawals are taxed at ordinary income rates once the investor reaches age 59 and a half or older. We also have a Roth 401k. So this again is a salary deferral plan. That's a defined contribution. They are funded with after-tax dollars, and that is what makes a Roth 401k different from a traditional 401k. The employer can make contributions, and the contribution limit for the employee is the same for a Roth 401k as it is for a traditional. Withdrawals are considered tax-free once the investor reaches age 59 and a half or older. Remember, a few other things about a Roth 401k is that there are no income limits for contribution. And once the investor reaches April 1st, following their 72nd birthday, they do have mandatory required minimum distributions from their Roth 401k. Let's take a look at a 403b plan. A 403b plan was not included in the ERISA law, included in 1974. It works like a traditional 401k, but it's not a 401k because it's not an ERISA plan. We often hear people refer to 403b plans as a tax-deferred annuity or tax-sheltered annuity. We abbreviate these TDA or TSA. A 403b plan invests in annuities and mutual funds. If an investor wants to take a withdrawal after age 59 and a half, there is no penalty. They must start taking withdrawals April 1st following the investor's 72nd birthday. And all money is taxed at ordinary income rates at withdrawal. A KEO plan or an HR 10 plan is a plan for self-employed investors or doing business as customers. For example, call and collect, doing business as Millionaires in Training and Associates. And everything perhaps may be taxed under my social securities number as the self-employed person. And this is considered in ERISA as a plan, and the maximum contribution is 25% of earned income, which is capped at $58,000. Let's look at individual retirement accounts. I'd anticipate for you to see a few questions on IRAs on your Series 6 exam. Remember that these are supplemental retirement savings plans, where the investor contributes money into this plan outside of their work plan. It's an individual retirement account, and the current contribution for this 2025 tax year is the maximum of 100% of earned income, or $7,000, whichever is less. Age 50 or older, we can always add an additional $1,000 per year, totaling $8,000 for 2025, and spousal IRAs are available. So if I'm a working spouse and I wanted to contribute into an IRA for my non-working spouse, I can, up to the $7,000 limit in 2025 per year, assuming that I have the earned income to fund it. Now, if we put too much money into our individual retirement account, there will be an excess contribution penalty assessed of 6%. So let's take a look at traditional and Roth IRAs. For a traditional and a Roth IRA, contributions can be made up until the investor's tax filing deadline. It is traditionally April 15th of the following year. For a traditional IRA, the tax status of contributions are before tax, but for a Roth IRA, they are after tax. The earnings in both plans will always grow tax deferred, and there is no phase out for income for a traditional IRA, but for a Roth IRA, there is. So if I'm a single tax filer and I make over $140,000 a year, I cannot contribute into my Roth IRA. If I'm a single tax filer and I make between $125,000 and $140,000, I can contribute some money to a Roth IRA, but my tax advisor will tell me the amount because the IRS will not let me contribute the full $7,000. So they have a phase out. Single tax filers making less than $125,000, they can fully contribute to the maximum contribution limit for a Roth IRA. For a traditional IRA, the investor must take out a required minimum distribution of April 1st following the investor's 72nd birthday. A Roth IRA has no required minimum distribution. A traditional does. Traditional IRAs, if the investor does not take out that required minimum distribution, the IRS will penalize the investor 50% on the amount that should have been withdrawn, the taxable portion of the RMD. Withdrawals before 59 and a half for both traditional and Roth IRAs, withdrawals before age 59 and a half are taxable, plus the investor has to pay a 10% tax penalty on that taxable portion. What is a penalty-free withdrawal for either plan? If the investor has died or they're disabled, primary education expenses, $10,000 for your first-time home buyer, and substantially equal payments under Rule 172T. Taxation on withdrawals after age 59 and a half for a traditional IRA, only the taxable portion is subject to ordinary income tax, while for a Roth IRA, if we've invested in our Roth for 5 years and we're age 59 and a half or older, we never have to pay tax on any of the earnings. We get them returned to us tax-free. So what about saving for education? The first savings for education plan that we have is a Coverdell Education Savings Account. The contribution amount is $2,000 per year per donor. All contributions are after tax, and we must stop contributing once the child, the minor, reaches the age of 18, age of majority in most states. And this plan is no longer available for use once the beneficiary reaches age 30, and if they choose not to use the money, they can take the money out and pay tax on it. And when I mean they, I mean the donor. If they don't use it, the donor can also transfer the money over to a relative of equal or younger generation. An educational savings account is very generous regarding what you can spend the money on. A 529 plan is for higher education specifically, whereas a Coverdell ESCA could be used for any level of education. It was originally used for contributions after high school, right? And it's treated as a gift. Section 529 plan is specifically for higher education. It was originally designed for school after high school. The contributions into the 529 plan are treated as a gift. We can contribute $19,000 every year without violating the IRS's gift tax rule, or we could do a $95,000 lump sum contribution per donor without violating the gift tax rule. Just know the multiple 5 times. So for example, the test doesn't expect you to know necessarily the exact contribution limit because they change it. They do expect you, however, to know the multiple of that limit. So for example, a few years back in 2019, I believe the contribution limit for Section 529 plans was set at $15,000. Right? So that's the maximum annual contribution limit. So you could contribute a one-time gift of 5 times that multiple. 5 times 15,000 back in 2018 would have been a $75,000 one-time contribution limit. However, we're in 2025 and they have raised the contribution annual amount to $19,000. So you could make a one-time annual gift one-time contribution gift 5 times the annual amount of $19,000. In our current year, it would be $95,000 one-time contribution to Section 529 plans. This allows grandparents or parents who've saved a lot of money to generously contribute to their nieces, nephews, grandson, or children's higher education. It's a great way for them to donate a lump sum into their future for educational needs. Just remember that 5 times multiple in order to effectively answer the questions when they come up on your exam. I'd also go in being prepared just to know the multiple regardless, because it doesn't take much to look it up. You can always check what your current year Section 529 annual contribution limit is. The IRS changes it, although remember that contribution limit of 5 times. For one time, 5 times the annual gift limit. So we could do a $95,000 one-time contribution per donor without violating the tax rule. And contributions into a 529 plan are not tax deductible, but earnings do grow tax deferred. So it is tax-free use of the money if it's used for qualified higher educational expenses, and $10,000 can be used for school below post-secondary school or college. So a couple of questions on 529 plans. The owner of a 529 plan is the donor, not the child. Would a donor take out money out of a 529 plan and not use it for education after high school and not be subject to that premature distribution penalty? There are 3 reasons. The child is deceased, they are disabled and they cannot attend college, or they've received a scholarship and they don't need it. If they don't need the money, they can transfer it to a relative or someone who does use the money or does need to use the money. Jump into the practice questions on millionairesintraining.com. Make sure you review the explanations, take some notes, and finish your quiz. With higher scores than 75, try and get 80s and 90% our exams on Millionaires in Training. I'm so excited to go through this class with you. I'm looking forward to moving on to our next video, and I'll see you soon in the next chapter.